Our strong belief is that the market is a little bit too optimistic about the global economy. So U.S. economy is likely to enter recession in the next quarter. And we also think that the European economy is now already in a recession. So ECB downgraded its growth forecast for next year to 0.9%. But they still believe that the Euro area economy can maintain a positive growth, which is too optimistic to us. So China economic momentum is likely to slow down going forward. So those recessionary scenario will work for Japanese yen against almost all currency pairs. And another important point is inflation is globally likely peaking at the moment. So if we look at the supply chain index like GACPI, that has peaked already in early this year and declining for the fourth consecutive month in August. And the input price DIs of the US and global manufacturing survey is also deteriorating at the moment. And slowing down in inflation tend to be quite positive for Japanese yen because monetary policy divergence may not widen from here that much. And also terms of trade of Japan is likely to improve going forward. So I think a big reversal in Japanese yen is likely over the next 3 to 6 months after short-term weakness.
This is Yujiro Goto of Nomura, a global financial services group. He believes that the Japanese yen is about to become a banana money. While US dollar to Japanese yen is about 143 right now, Nomura believes that it will be 130 by the end of the year. The Japanese yen has long been regarded as a locked, stable investment for many investors interested in investing in the Asian economy during uncertain economic or geopolitical periods, especially now that the Chinese yuan is fluctuating. However, lately, things seem to be going differently for it. There are many theorized facts that things may change after the yen fell lately to its lowest level against the US dollar in more than 2 decades. According to the options markets, the pricing of contracts that will pay off if the dollar-yen keeps increasing indicates that traders are wagering. Thus, there may be more to come. Welcome back to Savvy Economists. In today's video, we will discuss the Japanese yen and how it has gone down further in the past few weeks. Before we continue, don't forget to please watch, like, and share this video if you enjoy it. Also, leave your comments and thoughts below, and don't forget to subscribe to the channel for more related content similar to this. That being said, let's dive into the topic. What exactly is going on with the Japanese yen? On Friday, September 2nd, 2022, there was an unexpected pull down that caused a lot of outrage. This was because the Japanese yen fell to 0.0071 US dollars. For the first time in nearly 25 years, this has been its lowest price since the summer of 1998. The yen plunged past the crucial psychological level of 140 per dollar. And from the way it's heading, this trend may continue as the gap between US and Japanese monetary policy deepens. Even though different directions are being pointed as the cause of this, experts say that the primary cause is divergence in monetary policy. For better understanding, the monetary policy is how a central bank uses tools like interest rates, the money supply, and even currency levels to achieve its economic objectives such as maximum employment, stable prices, and others. When comparing between Japanese yen and the USD, what this means is that the US march toward rising interest rates while Japanese rates remain low, making dollar-denominated assets more attractive for investors. Thus, the Federal Reserve and other central banks are performing significant rate hikes while Japan's central bank is still maintaining interest rates at historic low levels. This contrasts sharply with the majority of other central banks worldwide and countries reducing their rates when needed. They achieve a better monetary value by increasing interest rates and reducing bond purchases. In the case of Japan, the Bank of Japan maintains a 0.25% restriction on the yield on Japan's 10-year government bonds, while yields on treasuries of other international banks have increased. There have been speculations that the USA and others will continue to raise rates aggressively. Whereas Japan's persistent trade deficit and the country's still modest economic recovery are both exerting downward pressure on the yen. This gradually makes it a loss for the Japanese yen. To get a more positive impact, many people are forcing the Bank of Japan to do more to boost the price of the yen against the dollar. The unprecedented decline of the yen has not benefited but hurt the economy, businesses, and consumers in equal measure. The severity of its loss prompts policymakers to consider whether currency intervention or a change in Bank of Japan policy are necessary to stop it from declining. However, even though the Bank of Japan wants to assist its economy with its monetary policies, It likewise prefers to take things slow in resolving the issues. Japan's government believes more has to be done to reinforce inflation in the minds of consumers and businesses after years of deflation because price increase in Japan is significantly slower than in the US. Another possible cause of the decrease of Japan's yen is the influence of China's yuan on other countries in Asia. A good example is how the recent pull-down price of the Chinese yuan likewise pulls down the price of some Asian currencies against the dollar, including this recent month of September. However, whatever seems to be the core cause of the yen decrease, one thing is for sure, this is harming not just the Japanese economy but also the purchasing power of its currency. It's interesting to know that at the emergence of the yen deduction, several Japanese people previously thought the yen devaluation was a thing to be celebrated. They even went ahead to push for policies to stimulate the weakening of the currency. But unfortunately, things are really not what they expect. Due to the neglect, the negative effect of the Japanese yen devaluation was completely realized in recent years due to the decreased competitiveness of Japanese businesses and the expansion of imported goods, including food and energy, smartphones, personal computers, and home appliances. Given this fact, the area of Japan's economy that is being hit worst by the yen's fall is household finances. Taking a look at Japan's manufacturing sectors, where a vigorous exchange of foreign and local currency does occur. The low value of the Japanese yen influences it. Since Japan's manufacturing industries have failed to transition to high value-added products since the 1990s, and they have been compelled to compete on price with South Korea, Taiwan, China, and other growing economies. As a result of this, some Japanese businesses quickly moved their production plants offshore as a result in order to reduce costs, which hollowed out the Japanese economy. These offshore subsidiaries kept the foreign currencies they had earned, which are mostly in USD. Since these earnings were not transferred to Japanese currency over the years, it has caused a decline in yen purchases based on the actual demand of export businesses. In addition to this, some foreign investors are no longer buying yen in the export sector. This caused China to overtake Japan as the second largest economy in the world, which is the second only to the dollar. Then, because of its position, the yen attracted a lot of investors looking for a safe asset to retain. This implied that there was a constant level of interest in buying yen. But this demand also decreased as Japan's economy lost ground on the world stage. Recently, the expanding Japan-US interest rate spread joined this decline in actual demand for buying yen, causing the yen to weaken more than anticipated. Also, Japanese businesses have been unable to raise product pricing as a result of the low level of domestic consumption. Between October and December 2021, the GDP deflator, which measures the change in prices created by dividing nominal GDP by real GDP, fell substantially below zero. The domestic demand deflator rises, and the overall GDP deflator does not plunge precipitously into negative territory if businesses can pass on the increase in import prices to product pricing. The fact that the GDP deflator is negative highlights businesses' inability to transmit price increases to consumers in the form of higher pricing for produced goods. In the end, many expect positive actions from the Japanese government or the Bank of Japan. On Friday, September 2nd, Japanese Finance Minister Shunichi Suzuki said the government would take appropriate action to tackle the devaluation of the yen's weakening. There is a possibility of them taking action for this because back in 2011, the Bank of Japan last mediated in currency markets after an earthquake and tsunami caused the Fukushima nuclear crisis. Also, if Japan gradually increases the interest rate and likewise keeps an eye on the economy's trajectory and the fiscal situation to maintain overall balance, higher rates will necessarily come with discomfort. Given this, Japan's biggest worry is that there doesn't seem to be a lot of political enthusiasm to accept the situation as it is and fight to improve it. In contrast to this anticipation, Dwight Evans of State Street Global Markets, when speaking to the BBC, feels there isn't much to be done. According to him, due to the disparity in interest rates between Japan and a large portion of the rest of the world, any measures or actions to lift the yen could prove futile. Thank you for watching. See you next time. Don't forget to like and subscribe to this channel for more educational videos.